Welcome to the Smarter SMSF podcast, the show where we discuss the latest insights, ideas and strategies with self-managed super funds, all designed to help make smarter decisions and equip you to be at the top of your game. I'm your host, Aaron Dunn. Hey there, Aaron Dunn here from Smarter SMSF. Well, what better way to get our podcast up and running again when we have the federal budget to go through. And tonight we've seen the Federal Treasurer, Scott Morrison, deliver the 18-19 federal budget. And it is a budget that is arguably the one that is going to take us into our next federal election. And most of that, therefore, is why we've seen the government focus on the attribution of tax breaks going back to individuals, most of it initially anyway centred around lower and middle income earners. But what we're going to focus on is the impact on superannuation generally and more specifically self-managed super funds. And whilst we haven't seen the great extent of change as we saw 2 years ago that really kept most of us up for most of the night, we have seen some tinkering around the edges of superannuation as we look to, in some areas, tidy up what were some of the previous announcements from those superannuation reforms from the 1st of July 2017, but a couple of other small items in there that will encourage people to continue to focus on superannuation. So let's just go through what the impact of some of these measures are. And the first is an announcement that we saw actually come about earlier this year, where we had an anomaly in the legislation around transition to retirement income streams. And what ultimately this has led to is in this budget, the change now to reflect a auto reversion of a TRIS to actually continue even in circumstances where the beneficiary themselves has not satisfied a condition of release. Because what was occurring under the current legislation is where that individual, the survivor, has not met their own condition of release, that we weren't allowed to continue that pension, the reversionary as such, because they haven't satisfied a condition of release that sits within the Income Tax Assessment Act. So 307.80 in the Income Tax Assessment Act meant that therefore that pension must cease and it cannot be a TRIS in the retirement phase, and therefore that automatic reversion would not apply. So like I said, we saw some consultation around this earlier in the year, and now we have in essence seen the government commit to these changes, and therefore off the back of that we will see that specific issue around that reversionary, regardless of whether that survivor or not has satisfied their own condition, to allow for that to seamlessly flow on. Now, what we have seen as a new measure is an extension to the super work test exemption for particular retirees. Now, back when we get to the 2016-17 budget, the government was looking to extend the ability for people to make non-concessional contributions between ages 65 and 74 and removing the work test. Now, of course, that did not proceed as part of the negotiation out around those rules, but what we now have seen is the government provide an exemption from the work test for particular non-concessional contributions for people aged between 65 and 74 when they meet two following conditions. So one is here that in that first year after they have basically not met a work test, they would be eligible to make a non-concessional contribution into super. But in addition to that, they must also ensure that that member has a total superannuation balance below $300,000 at the beginning of the financial year. So what is important to note with that definition is that it's not required to be maintained at or below $300,000 during that income year to be able to make those additional non-concessional contributions. Now, the existing concessional contribution and non-concessional caps will still apply in respect to this. So what it means is that an individual is not going to be able to apply any bring forward provision to extend the contribution beyond $100,000 where they are, of course, 65 years of age or right through age 74. The individuals also, where they have ceased that work test in the prior year, in that immediate year thereafter as well, they will also be eligible to use any unused concessional contribution cap amounts in that following year as well. So what is important to note here is that this legislation is going to take effect from the 1st of July 2019. And in Treasury, in the budget papers, in the fact sheets, they provide an example to give us some context as to how these rules work. So let's just go through this example. So at age of 68, Gus retires from full-time work on the 1st of June 2020. Now, he would not meet the work test in that following 2020-21 financial year. So under the current rules, he'd be currently prevented from making any voluntary superannuation contributions once we've got to the 30th of June 2020. Now, his total superannuation balance is $150,000 at the end of that preceding financial year, 2019-20. Gus is eligible to make contributions under this work test exemption between the 1st of July 2020 and the 30th of June 2021. So the conditions here are that his total superannuation balance was under $300,000, and in the immediate preceding financial year, he had met the gainful employment test, so the work test that would have enabled him to make contributions. So he therefore, in essence, has an extension of that work test for that following income year. Now, in addition to that, as Gus has not reached his concessional contribution cap over the past 2 years, having only contributed about $18,000 in the 18-19 year and $12,000 in 19-20, he would also be eligible, if he chooses to do so, under the existing carried forward arrangements and that work test exemption for that following year, giving him the ability to make a concessional contribution of up to $45,000 in that 2020-21 year. So in essence, enabling him to get that extra 20 in from the unused amounts in those 2 previous years. So if in summary there, as a result of this work test exemption that's coming in, Gus would be eligible to contribute up to $100,000 in non-concessional contributions in the 2020-21 year, in addition to that $45,000 of concessional contributions. So that is a great outcome in terms of providing additional flexibility for those individuals that may be recalibrating their arrangements as they move into retirement, to give them that extra year to get the advice and make the contributions that they may not have otherwise previously been able to do. Now, one of the other things that the government is looking to do is focus on improving the integrity around the way in which individuals can claim tax deductions for personal super contributions. Now, this is an area off the back of the budget for the changes that took effect from the 1st of July 2017. We now have this fantastic flexibility in the way in which an individual can utilise their $25,000 of concessional contributions. One of the gaps that the government has seen here that they're now looking to tidy up is to improve the process for the way in which the notice of intent in claiming super contributions has to be done. So of course we have to go through this process of intent to claim, and then therefore the super fund should ordinarily withdraw or withhold the tax in respect to the deduction that has been claimed by the member. However, the government notes that some individuals receive deductions on their contributions but are not submitting that notice of intent, despite the legislation in essence requiring them to do so. What this results in is a funding gap in terms of what is ultimately collected by the government, because it results in the fund not applying the 15% tax to their contributions. And as the contribution has been deducted from the individual's income tax, there's no tax that is paid on it effectively at all. So what this integrity measure is going to do is it will enable the ATO to develop a new compliance model with this and to undertake additional compliance and debt collection activity where it is warranted. In addition, it's now going to look at modifications to the tax return to alert the individuals to the requirement that they needed to have lodged or have prepared that notice of intent with a tick box that will confirm as part of the tax return that they have complied. So the ATO is going to also provide guidance on how individuals need to comply if they have not yet done so as well. And again, this will ensure that any deductible contributions are appropriately taxed by the super funds, and therefore will give the ATO the power to deny deductions to individuals who do not comply with that specific requirement. So that's an important loop as we see more and more individuals looking at whether they have the ability to claim a superannuation contribution tax deduction in their name. Making sure that intent to claim is done and done properly means that going forward, the ATO will have greater powers to deal with that specific issue. Now, the next one is an announcement that we actually saw the Minister Kelly O'Dwyer announce at the recent Self-Managed Super Fund Expo in Melbourne. And what the government is looking to do here is increase the maximum number of allowable members in to new and also into existing self-managed super funds and small APRA funds, and take that number up from 4 to 6. Now, this will take effect from the 1st of July 2019. And the objective here from the government is to provide greater flexibility for the joint management of retirement savings, in particular where we have large families. We go right back to the then Treasurer Peter Costello, that talked about this concept of having children, and one for mum, one for dad, and one for your country. I'm one of those where I have 3 kids, and it ordinarily won't allow me to incorporate my children, once they get of a relevant age, to potentially become members of the fund. So the reality of this measure is to enable those with larger families to ultimately incorporate them into their SMSF. The reality, however, is that when we look at the average number of members in an SMSF, we are around 1.9. So therefore, the real question is this really as a result of consultation, or is this simply a knee-jerk reaction to what was Labor's policy around the decision to ban the franking credit refunds? Because quite clearly, if I think about this in my own context, why wouldn't I look to become a member of my mum and dad's super fund and now potentially direct my contributions through their superannuation fund to ensure that rather than my parents losing on the franking credit refund, it could absorb mine, my brother's, my sister-in-law's, my wife's superannuation contributions, and therefore we end up with a bigger amount of that, which ultimately therefore leads to better outcomes across our family unit. So we have had consultation over many years, and this has been right back to the Cooper Review, where we saw this question asked, and it was quite clear at that stage that there was no real need to change the number of members in a self-managed fund. So to me, it does appear like it has that real flavour of knee-jerk, lack of consultation, and just making a decision off the back of what the Labor government proposed to impact SMSFs. But in saying that, I'll take it because I think it does provide further opportunities to consider some of the things that can be done inside an SMSF when we think about estate planning. We think about the way in which the investment strategy may be constructed, and provides greater longevity in the way in which the self-managed super fund can operate. And one thing that we haven't seen in there, but it was announced at the same time by the Minister Kelly O'Dwyer, was that we are going to see an extension of the SuperStream rules to effectively apply to self-managed super funds. And what this means is that we're going to have the ability for rollovers into SMSFs to go through SuperStream. And this is a real positive for the SMSF sector. It is going to, of course, go through some further consultation with industry throughout this year, but that's something that I just wanted to note, that we will see, and it will apply a far more streamlined approach to getting transfers from public offer funds into SMSFs. So let's keep moving, and we have now the next one here that looks at the changes around the SG obligations for individuals who, in essence, are going to breach their concessional contribution cap. So the government here is looking at allowing individuals whose income exceeds $263,157 and they have multiple employers to nominate that their wages from certain employers and therefore not going to be subject to SG from the 1st of July 2018. So the basis for this is therefore going to allow those eligible individuals, to avoid that unintentional outcome of breaching the $25,000 cap because of those multiple SG contributions coming into the fund. Now, the issue with this has always been that where you have the person that breaches the concessional cap, they will, in essence, be paying the top marginal tax rate. You go, well, that's not necessarily a problem, but it's the shortfall charge on the excess concessional contribution and the fact that it backdates to the 1st of July of that income year in which those contributions were made, therefore flags an amount that is far greater than what those individuals should ordinarily pay in respect to those above concessional contribution cap SG amounts. So the intention here, therefore, is the employees who use this measure can now effectively negotiate to receive those amounts as additional income, which in essence is still going to be taxed at the top marginal tax rate. It means basically that the government isn't going to get that excess concessional charge, but they are going to collect revenue a lot sooner than what would have otherwise been done because, of course, it will come through in the pay-as-you-go withholding regime. So it's not expected to have much in terms of gain or loss from a budgetary perspective, but I think that is a good and practical outcome as a result of this reduction that we've seen in the concessional contribution cap over time. And the other interesting one here is a proposed change around the auditing requirements for self-managed super funds, because we do have, as it currently stands, the requirement for an SMSF to be audited each and every year. Now, we do have, by and large, a community of SMSF trustees that do the right thing and do the right thing in terms of meeting their compliance obligations and ensuring that they comply with the statutory requirements in both a financial and compliance audit context. So what the government is proposing here is that they are going to change that annual audit requirement into a 3-yearly requirement for SMSFs, but on the basis that the trustee has a good record-keeping history and compliance. So we would infer that that means that they're documenting the decisions appropriately, so we've got no compliance issues in respect to that fund, and that their lodgements have been done on time and are up to date. So the basis for this is that it's intending on reducing that red tape for trustees that in essence have a good history, that history of 3 consecutive cleared audit reports, and that they've lodged those annual returns on time and met their compliance obligations. So this measure, if it receives royal assent, will start on the 1st of July 2019. And to ensure smooth implementation, we of course are going to see the government consult further with industry stakeholders. So this is going to present a real interesting dynamic for the audit profession, because of course we have seen a real thinning out of the sector, in particular with the audit registration process with ASIC. We've seen also changes around ASIC's funding model for auditors and the price changes that we've seen in the audit profession. And now we're going to see an impact on the way in which revenue is going to be derived. And this can have quite a substantial impact on how much an individual auditor, and in particular if we look at the sole practitioner auditor that might be doing 200 and 300 funds, whether and what, and in terms of looking at how they need to do work each and every year, they are now going to have some real challenges in the way in which their revenue would be derived, which is going to have an impact, I guess, on a pricing viewpoint if they ever wanted to sell their business or parcel of audit fees that they may have, but also around the need for staffing resources to get those audits done as well, because if you've got 300 in one year and then the next year you've only got 50 or 100 or whatever the case may be, it is going to be very cyclical and very difficult to be able to manage cash flow and manage the expectations at a business level. So whilst this is a good outcome for those that do the right thing from a trustee's perspective, there's going to be some real challenges in there for the audit profession who've already battled a whole range of headwinds in the past few years as we've moved into a regulated process, and then also seen changes in respect to the way in which their funding model is going to work to remain as an ASIC approved auditor as well. So here we are. We have, by and large, a fairly quiet budget around superannuation and SMSFs. There have been some other measures, some positive ones, I guess, if we think about some changes to insurance more generally, not requiring insurance for individuals, say, under the age of 25, as a means of trying to save on the costs, I guess, incurred around younger superannuants. And the abolishment of superannuation exit fees, again, was just another example of some of the other superannuation changes. So, again, we don't see any changes to the concessional cap. There would have been some positive changes, in my view, if we had maybe tidied up that unused catch-up concessional contributions. It could have been far simpler than what it currently sits at. But overall, I think we keep moving forward. Whilst we have the government having a little bit more money than they intended when we looked at the mid-year economic forecast, we still are in deficit and need to work through these times of budget constraint. So therefore, I don't suspect we're going to be seeing any great change to the way in which our concessional contributions and our non-concessional contributions are currently structured. So we move forward with what we've got. But I think, from what we've seen here, there are and continue to be some great opportunities across superannuation and our SMSFs in general. So if you do have any other questions about the budget or more generally about some of the policies that we are seeing that are going to impact superannuation and SMSFs more specifically, please feel free to reach out to me, team@SmarterSMSF, or get in contact with me across many of our social media channels. Thanks again for joining me for our budget update 2018-19. Take care and bye for now. Thanks for joining me today on the Smarter SMSF podcast. That was a smart move. If you'd like to find out more about today's topic, you can add a comment either at our website, smartersmsf.com, via our Facebook page, or using our Twitter handle @SmarterSMSF.